Well, I'm delighted to be here today with Ian Hancock, who many of you already know, the Montgomery COO. And we're also very pleased to be chatting today to Keith Balmer. Keith is Director and Portfolio Manager within the multi-asset investment team at Columbia Threadneedle. And we've been very pleased to work with Columbia Threadneedle for a number of years. So Keith, welcome and thank you for joining us today.
Thank you very much. Pleasure to be here.
So, Keith, markets have been very positive so far this year. What do you think have been the main issues impacting them?
Um, that's quite a broad question, really. But yeah, I mean, if you look, global markets are up around the world, with the Japanese market currently leading the way. They've made about a 25% gain so far. The USA is next, so America's made about 17%. That's the S&P 500, not the tech-heavy Nasdaq, but a broader US market. UK and Europe are currently some way behind, with UK generating just shy of about 6% gains, and Europe a couple of percent ahead of that. So the difference in performance, although all equity markets are up, the difference in performance between them is due to several factors relating to frequently the specifics of each region. So if we start with Japan. So why has Japan done so well? I mean, Japan's benefited from a very, very weak currency. If you look at the levels of the Japanese yen versus the US dollar, the last time we saw them this week was back in the mid 1980s. Now, a weak currency effectively benefits the exporters, and Japan has a lot of exporters, such as your car companies, your electronic companies, because when they sell their goods in yen, if you've got a weak currency, it means to say it's cheaper for everyone in the whoever's buying them internationally to buy them. So it's good effectively for trade for Japan. And secondly, there's been quite significant corporate governance reform that's been going on. And I say at the moment, this has been going on ever since Abe came in. So you remember Abenomics with his three arrows back in, that was 2012. Well, those corporate governance reforms are really just starting to kick in now. So you can see that with you get an increased dividend yield. So there's higher dividend payments being made by these companies, or indeed larger buybacks. So effectively, the companies in Japan are using their cash much more sensibly, more efficiently, which leads to effectively a better return on equity for those companies and hence better shareholder returns. So quite specific to Japan. If we look at the US, so the next best market out there, their economy has been one of the strongest globally, on the back of really high consumer confidence, stimulus plans such as the Inflation Reduction Act, or the IRA, which also always sounds a bit strange, and the CHIPS Act, so that's all around microchips. So lots of stimulus, so lots of government money being pumped into the US economy, and clearly that has got through to the consumers. Consumers have been able to spend lots more money, and that's in turn that nice virtuous circle working, which helps out profitability for US companies. Now that's coupled with having several very, very large technology and world-leading technology companies, best typified by the Magnificent Seven. So that's Apple, Alphabet, Amazon, Nvidia, Microsoft, Meta, which used to be known as Facebook, and Tesla. So they're the Magnificent Seven. So they're huge companies. And from an already dominant position, what we had early in this year was the explosion of AI. And so these companies have got a further boost on top of their already unenviable position that they've got in the world, where we're using more and more technology. AI has just gone and given a further boost to that. Nvidia is the standout performer, probably not one of the better known names out of that. I mean, everyone's hopefully familiar with Google or Alphabet and Amazon, but Nvidia is the standout performer from this group. They're up about 165% year to date. They effectively make graphics processing units, or different way of saying chips effectively, but these allow for huge amounts of data to be processed very, very quickly, and they've got the best one that's out there in the marketplace. And so anyone moving into the world of AI, trying to find the next bit of technology that's going to improve our world in whichever way, well, they're all wanting to use NVIDIA's chips. So effectively, NVIDIA's doing incredibly well, and that's one of the major reasons these seven companies why they've done so well. But that's also a potential area of concern. because you've actually had a very narrow market. Indeed, if you remove those Magnificent Seven from the S&P 500 index, then your returns would look much more like the UK than the just coming slightly behind Japan. So you've got very narrow returns there. Then moving on, so UK, why is the UK been a laggard? Well, it's kind of got the wrong mix to the listed segment of the UK. So the FTSE 100 or the FTSE 250. We've got the wrong mixture of industries for this type of economic environment. For example, we've got very little exposure to technology. So we're not benefiting from the increased use of technology. We've got a little bit less than 1% in the FTSE just to technology. So we haven't had that big swing up. And we've got a lot of exposure to defensive sectors such as energy. So these sort of old industries, which really aren't growing very well. So in a downturn, they do very well. But when things are going very well, they tend to lag the broader market. So different reasons for different geographies. But then overall, what we've got is we've got a situation where inflation has been high, but coming down. Interest rates have been high to sort of combat that. But they're now starting to come down. And once again, markets always look forward. And so therefore, if interest rates come down, it means to say that money is effectively cheaper. And so if money is cheaper, you're more likely to be able to go and do more investment. And so therefore, the markets are also thinking about what's going to happen going forward. So anytime you see an interest rate cut, you would expect to see all other things being equal, a jump in equity markets, and that's effectively what we've been seeing today. So some broad macro reasons, but also some micro reasons per individual country as to why they've all been doing well.
Thanks very much, Keith. That's very interesting. What impact do you think that the new Labour government might have on financial planning and our client portfolios?
Yes, obviously huge majority coming in from Labour. Now, the first thing to say is it was completely expected, and so therefore markets didn't really react on the day. So there was nothing new. There was no surprise in the fact that Labour got a super majority. There's no such thing as a super majority, not American. There's no surprise that they got a huge majority. So, what does that actually mean? Well, it means to say we're going to get a period of political stability because they've got such a large mandate. They can get through pretty much anything that they want through the House of Commons. And so therefore, they can put forward their manifesto and introduce that without a huge amount of opposition, which means to say stability. It also means to say, particularly relative to what we've been through over the past few years with the Conservative government, as long as nothing untoward befalls Starmer, we're going to have the same Prime Minister for a good period of time as well. So that means to say that international investors will be looking more fondly at the UK, whereas in the past, effectively, uncertainty is bad. So no one likes uncertainty. If you're going to decide to build a factory in the UK, well, you want to know that you've got a certain amount of certainty over tax policy, over foreign policy, in terms of employment policy, whatever it is. You need to know where you're going to be in 5-10 years' time. And definitely there was a feeling that under the Conservative government, certainly the latter part of it, we didn't have that. So that's the starting point. Now, what else? Labour government's quite lucky, really, because they're coming into power at quite a nice time. Growth starting to pick up. So the UK has moved out of recession. It's getting a bit better. Headline inflation is already back down at 2%. So target. Core inflation is still a bit higher, but that's also coming down. So therefore, that means to say rate cuts are quite likely to happen, which means to say, to all your clients, then probably your mortgage rates will reflect that if you're on variable rates. So therefore, consumers will be a little bit more confident. So from an economic perspective, it's all very attractive. They're getting it at a nice time. However, the underlying problems that the Conservatives had, that won't magically disappear with the new government. This country has a large amount of debt. So it's approximately 100% of GDP. So we've also got a desperate need for investment into infrastructure and into different institutions such as the NHS, but there's no money to pay for it. So what does that mean? How do you solve that problem? Higher taxes. It's as simple as that. Labour's going to try and do a whole lot of different things like supply side reform and try to get more productivity. But effectively, the easiest way of reducing the debt burden and allowing for increased investment into infrastructure, etc., would be through higher taxes. Now, Labour's already ruled out increasing income tax, national insurance, and VAT, which are the three largest source of tax revenue. So it means to say that they'll, if they've ruled those out, there's going to have to be a whole lot of other smaller changes in lots of different places. So in their manifesto, we already know about VAT on private schools. So private school fees, you're now going to have to do that. So in terms of your clients who've got kids going through private schools, the good news for them is that there was a possibility that was going to be enacted straight away. So that would have been in place for this financial year or this school year coming. But Rachel Reeves has said that they won't be for next year. So you can hopefully save up a little bit more in between that. But yes, VAT will go on private school fees. If you've got any non-dom clients, well, those loopholes will be further restricted. If you've got anyone who works in private equity, I'm not sure if you do or not, but there will also be tighter tax on what they call carried interest, but effectively lots and lots of squeezing going on. But there's going to need to be lots of these options because those three measures really don't actually generate a huge amount of tax revenue. They sound good in terms of headlines, but really they probably won't raise a huge amount. So where's Labour going to be looking? Most likely candidate, unfortunately, looks to be capital gains tax. So if you think about the tax-free allowances that the Conservatives effectively reduced and took away on capital gains, so that's already happened. So you probably can't do that, which means to say that if you need to raise more money, then the rate will probably have to increase. And whether that's a fixed rate or whether that becomes your marginal rate, I would expect capital gains to increase. Maybe not first year. I mean, we'll see, but yes, that's one of the taxes that I would expect to go up. Now, what does that mean in terms of financial planning? Well, that could have quite a big impact on how investment portfolios are held outside of tax wrappers. So if you're inside an ISA, for example, it doesn't matter. If you're inside a pension, that sort of thing doesn't matter. If you've got assets outside of that, then potentially your tax liability, your capital gains tax liability, will mean to say that will be something that you have to be very much aware of. Other areas that could get tightened up, so inheritance tax. So once again, in terms of financial planning, could be quite critical. So potentially, and none of this has been announced, so this is all pure speculation, but potentially looking at your SIP, so your pension, moving that into your sort of inheritance taxable amounts. So that could be quite a big impact. There's a whole lot of exemptions at the moment that could get rid of. So, for example, if any of your clients own agricultural land, you can sort of pass that down through generations without being liable for inheritance tax. They may change that. But I mean, it's all speculation. But generically, in order to do all these spending plans that Labour's got, they have to increase tax, and they've ruled out the three main ones. So it's going to come in different areas. So yes, financial planning, effectively watch this space. But yeah, my guess is there will have to be slight changes to the way that your assets are either held or you want to have them invested.
Yeah, absolutely, Keith. We're watching this space, and I know our clients are too. But
just one thing. So I had one thing I forgot. In terms of the lifetime allowance, because that's one thing that I have heard an awful lot of people ask about. They have ruled out immediately putting that back in place. So it will stay for the foreseeable future, as there will not be a lifetime allowance in terms of your pension. But when Conservatives took that away, Labour were against it. So that would potentially be another area where potentially you would see a change. And obviously that could affect quite a few people.
Yeah, absolutely, Keith. Thank you. Ian, any comments or anything you want to say?
No, the only one I was going to ask, Keith, is inheritance tax, which I know is obviously of concern to a lot of our clients. Any view on that one?
With inheritance tax, I think you're going to get more and more things going to get dragged in. I don't think you're going to see changes to the amounts, as in levels that you can sort of pass through inheritance tax free. So you still think it's going to be progressive. But as I say, so things like agricultural land getting moved across into that, maybe SIPs getting moved across into. So effectively, anything that's exempt from inheritance tax at the moment, that would be an area where potentially Labour will be considering whether to put that back into the inheritance tax liable band. But yeah, it's difficult to say anything with any certitude because they haven't told us.
Yeah.
So we'll find out.
We will indeed. So, Keith, how concerned do you think we ought to be with the outcome of the US election?
Well, let's ignore personal views on the individual candidates. Let's get that out of the way. I'm not going to take a view on Trump or Biden. But to be honest, I don't think your client should be that concerned about either outcome. Now, there is obviously a third outcome on this one, which is Biden could potentially step aside. Clearly, his performance during the latest debate was awful. And the polls have moved from very much a sort of a 50-50 even running to very clearly being a Trump winner at the moment as it stands. Now, they're not voting until several months' time. So lots could change in between, including the candidate. Yeah. So if you get a new candidate in and they actually come across relatively well, I think they could actually be the front runner. But bottom line is, I don't think it really makes that much difference. The reason for that is that basically the policies on both sides, whether you're Democrat or Republican, is broadly the same. Trump and Biden are basically running on feel-good politics, which is spend, and leave the consequences of unfunded budget deficits to future generations, and they can deal with that problem. So the tariffs that, so effectively, there's going to be certain consequences of that, but we sort of go through individual bits. So sometimes people think, Trump is the tariff king. All the tariffs that Trump initiated back when he was in power in his first term, well, none of them were withdrawn by Biden. In fact, Biden's actually increased the tariffs. So neither of them are the tariff kings. They both have enjoyed high tariffs, which is generally not good for international trade. It's not good in terms of prices. So you get a little bit more of inflation coming through on that if you get high tariffs. So what you may get is slightly higher tariffs under Trump. So that's something. So at the margin, not great for global trade. Clearly bad news for China. But to be honest, probably actually quite good news for Mexico and Canada. So that sort of onshoring, nearshoring, friendshoring, where you get around the tariffs by just sort of placing yourself in the North Mexico or in Canada. And bring it through. So it's good for those countries, bad for China. But I say once again, not particularly different between the two of them. Probably at the margin, Trump will increase tariffs a little bit more, but I say Biden's increased them from where they were. So if Trump gets in, you'd expect him to sort of be a little bit more corporate friendly. So that means to say reducing taxes. So when Trump, once again, when he was in for his first term, he actually enacted a reduction in corporation tax. Now that has a certain time limit on, and that's going to be expiring next year. And so if Trump was president, you would expect him to continue to have that cut in corporate tax rate. However, if the Democrats get in, so if Biden or whoever it is, whoever's running mate might be, gets in, then in that situation, you might be more likely to see that corporation tax increase. So once again, if either of those two outcomes happen, then with Trump, it's probably going to be slightly better for equities. And with Biden, it's going to probably be slightly better for bonds. But these are sort of at the margin. It doesn't really make too much difference. So what else? Neither of them have been grown-ups in terms of we've got a debt problem. So debt is currently around $34 trillion, which is a big old number. It's about 120% of America's GDP. So we're on about 100%. They're on about 121%. So unbelievably, the US is in a worse position than we are in terms of the debt. And that will increase under both Biden and Trump, or due to increase under both Biden or Trump if they can enact all of their policies. At the margin, once again, probably a little bit more under Trump than Biden. So therefore, probably once again, slightly better for bonds under Biden than under Trump, but not really good for bonds under either of them. Under Trump, the US will continue to look inwards, so much more inwards, think about themselves. So clearly that's going to be bad for Ukraine, as an example. And migration or immigration will continue to be a focus, but that's the same for both of them. So you're still going to get huge amounts of column inches and words being spoken about it, but also, spending that's directed towards it. But once again, it's not really, doesn't make too much difference. So really the key question is not who will be the next president of the United States, but will either of them win a clean sweep? So in the US, they have the House and the Senate that makes up Congress, and the White House. So the president has quite a lot of powers. So the sort of the worst case scenarios in terms of being able to get all of those spending plans, those unfunded spending plans through, would be if you had a clean sweep. So the House, the Senate, and the White House are all either Democrat or Republican. So if that does happen, so if you have a clean sweep, it's generally probably going to be viewed bad for bonds, and absolutely fine for equities. So probably just at the margin, relatively good, certainly over the short term. So actually, overall, it's going to be better. So should your clients be concerned about the outcome of the US election? Well, the best outcome is, once again, ignoring personal views on candidates, would be if you had a divided House and Senate and White House.
Yeah. Okay. Thanks, Keith. Anything, Ian, that you want to say? Any questions?
No, that's fine.
Thank you, Keith. So, as you know, we're very big supporters of multi-asset funds. Why do you think the multi-asset funds are still a good way for our clients to invest?
Yeah, I mean, look, there's several reasons why multi-asset funds are a great way for clients to invest. Firstly, ease. You've got, so if you invest into, say, the universal range, we've got a dedicated investment team here, and all we do is effectively look at the markets and try to understand from a macro perspective what's going on in the world and how that's going to affect asset prices. So, you've got a dedicated investment team managing your money to specific risk levels. Within universal range of funds, you don't just get asset allocation decisions made on your behalf. So, whether you want to have more stocks or more bonds, or whether you want to have more US equities versus UK equities. But we also use underlying investment teams across Columbia Threadneedle, and they choose the individual stock. So you get a little bit of stock selection on top of that. And, since we first started, that's been positive. So we've outperformed just buying a broad-based index. So there's lots of sources, easy sources of extra return for you, or potential return for you. Second one, multi-asset funds, sort of tax efficiency. So given what I talked about in terms of potential capital gains tax changes, multi-asset fund in a daily liquid OIC, so an open-ended investment company. So that's just the fund structure that we use. That means you can manage your potential capital gains liability whenever you want. So you will only get that capital gains liability when you sell down units of that fund. Yeah. Therefore, you can control exactly when you have that liability or not. If you held individual investments yourself, or you hold it through, say, a managed portfolio service, well, because they will be selling, so that managed portfolio service or a discretionary portfolio service, or they will be selling and buying those bonds on your behalf. So same sort of thing as we do multi-asset, but just without that wrapper around it, which means to say that capital gains liability happens not when you want it to, but when the manager is actually trading. So you get less control.
Yeah. That's a huge point, Keith, something that we're always talking to our clients about, and I'm sure you're going to come on and talk about the risk aspect as well in the client portfolios.
Yeah, so we can jump to it. So just, I suppose, tied into that, so diversification would be the other one. So multi-asset fund, with one simple investment, you can get access to a nice, cheap, easy way of getting broad-based exposure globally, across asset classes, typically in a much wider range of asset class and geographies than you'd be able to do on your own. So you can get that diversification, which is one way of reducing down the risk. But clearly you get, once again, that investment team to decide exactly when is the best time to go into or out of that. And then the fourth one is very much around that risk management. So not just in terms of I'm sitting here inside a Columbia Threadneedle's offices in London. We've got an independent risk team that are making sure that we're doing what we should be doing. They come to us with certain analysis saying, have you considered this risk and that risk? So not only are we doing the risk management ourselves online, but we also have independent risk profilers outside of the organization to make sure that we stay within those sort of risk parameters. So multi-asset fund, risk rated, it allows you to have that sort of that comfort, if you want, that your risk levels are going to be relatively consistent through time, certainly over the long time, which should, hopefully, as long as you've been matched up correctly, match your own risk tolerance.
Yeah. Thanks very much, Keith. Ian, anything you want to ask?
Yeah, no, I think that's the sort of the same sort of story that we explain to our clients, Keith. So thank you for doing that. It's really good. And Some of our clients that will be listening to this will also be invested in the Universal Map range of funds as well, that you guys manage for us. So I think that bit about capital gains is to me one of the biggest hot topics at the moment, and I think it's one of the biggest reasons why investing into multi-asset funds at this particular junction is probably one of the best decisions that people could make. So I agree completely.
That's great. And I suppose the last thing is, depending on what your clients are doing. So, you know, you've got all these different ISAs. So you got your junior ISAs and everything else like that. With a multi-asset fund, you can invest £1,000 into a multi-asset fund, and you get all this broad-based diversification for that. You can invest 150,000. That's absolutely fine. But clearly, you can't invest 100,000 yourself directly into all these different areas because you don't have enough money to go around. So nice and easy, nice and simple. And as you say, somewhat more tax efficient than maybe other structures.
And I think sometimes, Keith, our clients in the past have felt that, you know, you need to have lots of funds in a portfolio. You know, you need 20, 30 funds, and that's what makes up a portfolio. And I think sometimes and perhaps we need to explain, actually, you could just be sitting in one fund, one multi-asset fund, and your exposure to all those different asset classes underneath it will be vast and will be huge in terms of companies, funds, bonds, cash, everything. But
well, if I take Universal as an example, so Universal Balanced, say for example, you know, the one in the middle, inside that there's about 200 individual equities, so individual companies that we hold the equity of, and then there's about another 600 individual bonds. So you're getting 800 positions just in one investment.
Yeah.
So you get that diversification once again, nice and simply.
Yeah, thanks, Keith. Really important.
Brilliant. Thank you very much, Keith.
Not a problem. Thank you very much at all. Thanks for your time, and thanks for inviting me along.
Thanks, Keith. Thank you.